Hello friends, in this session we will discuss bank finance management Basel III framework on liquidity standards. So friends, this is a very interesting chapter. So we will learn about Basel III framework in this chapter and mainly the liquidity standards which are prescribed in the Basel III we are going to discuss. Okay, so first we will discuss some Basel III introduction part. Okay, so see, actually what happened, we all know very first Basel came in 1988. Okay, and we know in 1906 there was some amendments, right? And Basel 2 came in which year? In the June 2004. Okay, the Basel 2 came, right? So we know this is the all the steps happen in case of a Basel 1 came in the year 88 and 2 came in 2004. Despite of that guidelines by the committee in Basel 1 and Basel 2, what happened? We all know in 2008 there was a very big recession, and the major reason about that recession is the collapse of the Lehman and Brother company. Collapse of the Lehman and Brothers in the USA. That was the major reason of that recession. So the committee think that we have prescribed Basel, the very good guideline in Basel 1 and again Basel 2. Though we are facing the crisis, that is a failure of the banking, right? So what happened? The company started thinking and they have developed a Basel 3. They have developed a Basel 3. Okay, so this is the background of a Basel 3. So now we will discuss the what is actually inside the Basel 3. Okay, we all know, but the major crisis which happened in 2008, Lehman and Brother, the major reason was the liquidity risk was the main reason. So that's why the Basel committee think and worked on it, and they came with some guidelines. Okay, so that we have to discuss in the Basel 3 liquidity standards. So first see some introduction part. See, as I have already told you, Basel 2, an international accord for the banking regulation that was formalized in June 2004, right? And after formalization of that accord, that means after that guidelines in the Basel 2, just after 4 years, that in 2008 the collapse of the Lehman Brothers happened, right? So since Basel 2 accord could not save the financial institution or avoid the happening of a subprime crisis, BCBS has come out with the next standard. Why? Because due to the Basel 2 we are not able to save the Lehman and Brothers financial institution. That's why we come out with the Basel committee come out with the new guideline called as the Basel 3. In which year? Remember, in Basel 3 came in 2010. Okay, this is the background of a Basel 3. Now we will discuss Basel 3. So what was introduced in Basel 3? Basel 3 has an introduction of a leverage ratio. So what was the leverage ratio? See, the introduction of a new liquidity ratio. For example, liquidity coverage ratio, that is called as the LCR, and net stable funding ratio, that is the net stable funding ratio, NSFR. So in Basel 3, what was the main two objective? What was the main two thing that was introduced? First, they have introduced the LCR, that is the liquidity coverage ratio, and second is the net stable funding ratio, that is a NSFR. Okay, remember, just in a broad view, what was mainly in Basel 3? They have introduced a two leverage ratio. First is the LCR and second is the NSFR. Okay, next, what are that ratio actually? That we have to only discuss in that chapter, in this chapter. And remember, this is also very important. This is very important to calculate LCR and NSFR. Also the case study also we will discuss based on that. So friends, start with the actual theory. What is the concept of a LCR? So see, these two ratios mandated to account for the high quality short term assets and stable funding sources respectively. That means first ratio, the LCR, what it mandated? It mandated the high quality short term assets. That means in LCR, it is mandated that bank should have high quality liquid assets, HQLA. That is, and for short term, it is for the short term. That means in LCR, it is prescribed that bank should maintain the high quality assets first. And in case of, remember, in case of NSFR, what is the mandate? It is a mandate that to overcome the liquidity risk of the bank, it is mandated the stable funding sources. In case of NSFR, the stable funding sources, should be with the bank. Bank should have the stable source of a fund. Bank should have the stable source of fund. So this is the very broad overview. LCR, in case of LCR, it is mandated that bank should have HQLA, that is a high quality liquid asset for short term. And in case of NSFR, it is mandated that bank should have stable funding sources. Bank should have stable funding source. That means whatever the sources with the bank have, that should be a stable. Okay, so this is the requirement of the NSFR. So remember, as it is for the short term, it will be for medium as well as the long term. Okay, so we will discuss all the things in a detail. First, see, here is the some thing which is important. See, the liquidity is crucial to the ongoing viability of any banking organization. We all know liquidity is very important. If you are not having sufficient liquidity, then we may have some face to some crisis, right? So that's why the statement made by the Basel committee in 2006, what is the statement? Liquidity is a crucial ongoing viability of any banking organization. And also remember, the BCBS has not specified any capital for mitigation of the liquidity risk. This is the most important statement. What is the statement? The BCBS has not specified any capital for mitigation of a liquidity risk. This is the most important, because this is most probably this will come near true or false. So in that case, you must remember what we remember. In case of a credit risk, there is a capital requirement, there is minimum capital requirement. In case of operational risk also, and in case of a market risk also. But in case of a liquidity risk, there is no minimum capital stipulation by the Basel. That is the point that you should note here itself. Okay, so it is a very good thing that we need not to be worry about calculation of a capital requirement for the liquidity risk. Okay, because it is not stipulated, right? So don't note here, I repeat again, BCBS has not specified any capital for mitigation of the liquidity risk. So how can we mitigate that? That is mitigated through by maintaining the liquidity coverage ratio and the net stable funding ratio. Okay, so that we have to only discuss. It is very interesting and easy part, friends. Okay, so now let's move further. See, the inclusion of a LCR, that is a liquidity coverage ratio, is one such measure has the aim of what? Securing the institution, and for what? Short term financial solvency in a hard 30-day calendar stress scenario at any time, also in time of crisis. So what do you mean by that? See, the LCR, what is the LCR? It is purpose of LCR that bank should be secure. Your bank should be secure. And in case of what? In case of a short term, remember, in case of a short term financial solvency, And what is short term? That if the bank is failed, LCR will ensure that for next 30-day bank will survive. Remember what I am saying. If the bank is facing some crisis, LCR should ensure that for the next 30-day bank should survive. Okay, that is the main objective of LCR. Why only 30 days, sir? Because in that 30-day, the regulator, for example RBI, may come forward and do some prompt corrective action, and other plans may be proposed. Okay, so that's why this is very crucial. The LCR plays a very crucial role in case of a liquidity of a bank. Okay, now see, the next is the the another significant measure for the strengthening of a bank is the for medium to long term liquidity profile is the net stable funding ratio. So what we have learned, LCR is for the short term and NSFR is for the long term. So both medium as well as the long term. So both our total duration has been covered. If a bank is facing some short term crisis, bank will deal with the LCR, and for long term duration bank has to maintain the HSFR. Okay, so it is a NSFR, that is a net stable funding ratio. Okay, so now see, we will discuss one by one ratio in detail. Okay, that we have to only discuss in this chapter what is a LCR and what is the net stable funding ratio. Okay, that topic we have to discuss only, and based on that we have to do the one case study which is very, very important, and again we have to discuss the numericals as well as the MCQs also. So first let's begin with the LCR. So what is the liquidity coverage ratio? So what is the liquidity coverage ratio? See, LCR is designed to ensure that bank hold sufficient reserve of what? High quality liquid asset to allow them survive for a period of a significantly liquid stress lasting for 30 calendar days. What is the main purpose of LCR? LCR ensures that bank should have sufficient reserve of what? High quality liquid asset. Bank should have good liquidity assets, good quality liquid assets to allow them survive for what? For the period of 30 days in case of any crisis or the any crunch or in case of any stress. Okay, that is the purpose of LCR. Now see, why that only 30 days? Because the 30 calendar days stress period is a minimum period deemed necessary for corrective action to be taken by the bank's management or any regulator. That's why there is only 30 days has been mentioned. Okay, so now we will discuss the what are the objective of LCR. What is the objective of LCR? See, the LCR standard aim to ensure that bank maintain the an adequate level of bank should maintain the adequate level of unencumbered HQLA. What is unencumbered? See, unencumbered means the assets. Unencumbered means which is having no any legal problem or no any operational problem or no any obligation. Okay, that means it should be ready to sell. It should not have any legal obligations, legal problem, operational problem or any obligation. That is called as the unencumbered, right? So what is a HQLA? That is a high quality liquid asset. What is high quality liquid asset? See, cash is a high quality liquid asset. It is a liquid asset. You can easily, it is easily available. See, second example I will tell you. See here, what is a HQLA? First we will discuss it in detail, but here for the instance, see the HQLA. See, if you are having a plot, having worth of 10 CR and you are having a gold of worth 10 CR, then which you can sell easily in the market, which will give you money? Definitely gold you can easily sell, right? So gold is what we will compare. Gold is having high liquidity as compared to your land, That's why we will count gold in case of what? The HQLA, right? Which the asset which you can easily in cash, we will call it as HQLA. Okay, so what is the objective? Objective is that bank should maintain the adequate level of unencumbered HQLA. Okay, now that can be easily converted into the cash to meet the liquidity needs for the 30 days. First, what is the criteria? What is the objective? Bank should have the high quality liquidity asset so that in case of a crisis in the next within 30 days bank can encash that assets. Bank can encash the asset for and can survive for the next 30 days. Okay, now see, next we have to discuss a significantly severe liquidity stress scenario specified by the supervisors. At a minimum, the stock liquidity assets should be enabled the bank to survive next 30 days, and for which we can take some action for the next period. Okay, so basically what is the LCR? I repeat, LCR, that is objective of LCR, that is the liquidity coverage ratio, and that ensure that bank should hold the HQLA. HQLA means high quality liquid asset. Why to hold that high quality liquid asset? So that in case of any stress or in case of any liquidity crunch, bank can encash that assets and can survive for the next 30 days. That is the concept, that is the first objective. Now see, next, what is the scope and applicability, where it is applicable, and what is the scope of that LCR? First, it is very easy. See, it is applicable for Indian banks at a whole bank level. What do you mean by whole bank level? See, for example, your Union Bank of India having a branches of 100 branches, say in USA, and having 12,000 branches, say in India. Okay, so I'm not much sure about the figure. So the LCR is applicable to UBI as a whole. That means the 12,000 and 100 total branches will be under the LCR. Okay, that means for Indian banks it will be applicable at a whole level. Okay, and in case of foreign banks, the operating branches in India, the framework would be applicable on a stand-alone basis, that is only for the Indian operation. That means if a foreign bank, say the USA bank, the Bank of USA bank having branches in India, 10 branches in what? In India. They are having 10 branches in India. So only to that 10 branches, that a criteria of LCR mandate is important, that is compulsory, not for the USA operation in the USA. Okay, so what is the scope and limitations? For Indian banks it is applicable at a bank level, but in case of foreign banks it is only for the Indian operation in India. The branches in India functioning, for them only LCR is applicable. Okay, in case of foreign banks. Now we will discuss in detail what is the definition of a LCR and what is the formula for LCR. Okay, now see, the RBI requires scheduled commercial banks in India to hold the stock of HQLA, that is high quality liquid asset, should be held by the commercial banks at least as large as expected total net outflow over the stress period. Okay, and it is summarized in the formula. So basically, what is the formula of LCR? See, LCR is very important formula. Friends, it is very important that you should note the formula. What is the formula? The total HQLA, it is divided by the cash outflow in next 30 days, and it should be greater than your 100%. It should be greater than or equal to, say, 100%. So what is the formula for a LCR? You have to remember, LCR is nothing but your high quality liquid assets and divided by cash outflow in the next 30 calendar days. Okay, so this is the very important formula. Based on that, we have to discuss the numerical and case study also. So just remember the formula. It is when we discuss the case study, at that time you will get very much clarity about the LCR. Okay, so this is the formula. Now see, there are some RBI circulars. We will discuss that also about the LCR. See, as per the RBI circular, the LCR requirement would be binding on the bank from January 1st, 2015. For first MCQ, when the RBI mandated the LCR, that date you should remember. Since the 2015, the liquidity coverage ratio is mandated by the RBI. Okay, and to provide the transaction time for banks, the requirement would be 60% for the calendar year 2015. As in the first year, that is in 2015, first time RBI has mandated. So RBI said we will give some time because first time we are implementing India, so you just maintain 60%. You just maintain LCR 16% for the year. Okay, so it will be effective from 2015, and minimum level of requirement should be 100% on January 2019 onwards. So it was the beginning period. That's why RBI said you just maintain 16%. But remember, currently it is 100%. Since January 2019, RBI said it is a time you have taken a lot of time. You have to implement LCR, and that should be more than 100%. Okay. So actually, what is the importance? Just remember one important line: liquidity coverage ratio and net stable funding ratio, it should be high as possible. If it is high, that means your bank is very safe. That means your bank is very safe. Okay, so the LCR and NSFR, that is a net stability funding ratio, should be high possible. Okay, and minimum requirement is it should be 100% as per the RBI. Okay, see now, see this, there is the dates and what is the LCR as per the RBI. So in the first year RBI said you just maintain the 60%. So in next year RBI increased by 10%. Again in next year RBI increased gradually 10%. In 2018 19%, and since 2019 RBI said that you have to maintain 100%. But what happened? This is the latest update. You will not find that update in the books, right? So remember, further update about that LCR is that RBI has released one circular in April 17, 2020, and due to the COVID-19 pandemic situation, RBI has permitted the following revised guideline. In last year, that is in 2020, RBI has, due to the COVID-19 pandemic, given some instruction. See here the latest update. So RBI said you should maintain from September 30, 2020, you just maintain the 80% of LCR, and from October to March 2021, you should maintain the 90% LCR, and 1st April 2021 onwards, you have to maintain 100% LCR. So which guideline you have to remember? The latest data guideline is very important, because IIBF is very smart. They will ask you question based on the latest guideline. Okay, so they will not ask you on 1st April 2021 onwards, because obviously we all know it will be 100%, right? So most probably they will ask up to March 31st 2021 what was the minimum stipulation or mandatory stipulation by the RBI for the LCR. Okay, so remember, for March 30 up to March 31st 2021 it was 90%. Okay, now we have discussed LCR. Now what is the HQLA? We have discussed LCR, that is liquidity coverage ratio. It is nothing but your high quality liquid assets divided by your cash outflow for next 30 days. Okay, that we have discussed. But what is HQLA? Again we will discuss in detail. See, the liquidity assets comprise of the high quality assets that can be readily sold or used as a collateral to obtain the fund in case of the stress scenario. What do you mean by that? See, we all know liquid asset means you can easily encash that. But what is the high quality of that? High quality of that is nothing but very simple. You can more easily encash. Okay, for example, I have already explained to you, but see again, if you are having a plot of worth 10 CR and you are having gold of worth 10 CR, which will be having liquidity? Definitely plot will be having liquidity, but it will take some time. You have to find the buyer. But in case of a gold, buyers are very ready. You can easily sell the gold, and so we can say the gold is more liquid. So what we can say, the gold is having high quality. This is just for example. We will discuss what is included in the HQLA and all that. We will have to discuss here itself. Okay, so, and provided that assets should be unencumbered. What do you mean by that? It is mean that assets should be having without legal regulatory or any operational impediments. Okay, that means there should be no any obligation, there is no any legal matter is going with that asset. Okay, so that is the also provided criteria. So what is HQLA? We have discussed. That is basically, it is very simple. It is the assets which you can easily encash, you can easily sell that asset, and you will have some money to save your bank. Okay, this is just a simple funda. Now we will discuss the next topic. We have to discuss, there is some category about the HQLA. Okay, we have discussed the HQLA. What is HQLA? We come to know. Okay, concept of HQLA we know, but the HQLA has been further classified. Okay, it is further classified, that we have to discuss. See, assets are considered to be high quality liquid assets if they can be easily and immediately converted into the cash at a little or no loss of a value. Okay, that's why I already explained you, the high quality assets are the assets which you can easily encash. Okay, so see, there are some fundamental characteristics of these assets, which include they should have a low credit risk, they should have a low market risk, they should be easily and certainly they have easy and certain valuation, there should be a low correlation with the risky assets. Okay, these are very easily and common sense you can apply here. The fundamental characteristics of the high quality liquid assets, having low risk and a high certainty about the valuation, and that is the basic things. Now the main thing what we have to discuss is the category. We have to discuss the category of the HQLA. So remember, very first, at a first instance, see, there are two categories of the assets which can be included in the stock of HQLA. So basically HQLA include level 1 and level 2 assets. So what you have to remember HQLA having two types. First, having level 1 and second is level 2. And remember, level 2 again further classified in the category of A and category of B. This is just overview classification of HQLA. HQLA is having two types, first level 1, second level 2, and level 2 further classified into the A and B. Very simple. Now what is level 1, level 2, we'll discuss here. See, the level 2 assets are subdivided into the level 2A and level 2B. Okay, and on the basis of what? On the basis of their price volatility. Okay, on the basis of their price volatility. So here is a question, one liner MCQ can be framed that level 2 assets are subdivided into the category of 2A and 2B on the basis of. So you have to remember it is the price volatility. We will discuss how it is a price volatility, but here you have to remember the price volatility. Okay, so first before going to directly to the discussion about the classification, here is the some features of assets has been discussed. So you just read that feature. Okay, so that that is not important for your exam point of view, but as they have in the syllabus, we just read it because they have given, you should know what are the features of the assets. So it should be available all the time to convert in the cash, it should be unencumbered, it should not be co-mingled or used as a hedge or a collateral on the trading position, right? It enhancement in the structural transaction designated to cover operational cost. It should be managed with the sole intent for the use of a source of a contingency fund. So these are the basic characteristics and the feature they have given. So we will discuss the main important part which we should discuss here is the HQLA. Okay, so what I have told that a HQLA is having two types. First is the level 1 and level 2. First we will discuss what is the first type of HQLA is the level 1 asset. So what is level 1? The level 1 asset of a bank should be comprised of following, and these assets can be included in the stock of a liquid asset without any limit and also without applying any haircut. So what is HQLA? Level 1, these are the assets which you can include. Level 1 assets are the assets which can include in the stock of HQLA without any limit. That means if you are having a 5000 CR amount of a level 1, you can consider that in the HQLA. Okay, but this is not the facility available in case of a level 2. That's why that point is very important. There is no any minimum or maximum stipulation that level 1 asset should be held by the in the category of HQLA. So without any limit you can have level 1 assets which can be counted in the HQLA. Okay, and without applying the haircut. That means if you are having 100 CR of what of a level 1 asset, then all the 100 CR will be counted in the HQLA. Okay, haircut means if you are having 100 and out of that only 85 is counted in the HQLA, then we can say there is a 50% haircut, 15% haircut. That means, but in case of a level 1, remember, in case of a level 1, the haircut is not applicable. The full amount should be counted in the HQLA, that is high quality liquid asset. Okay, so what we have learned here in the first, remember, very important for level 1, just remember there is no any limit that how much level 1 should be included in the HQLA. You have maximum, whatever the maximum, it is good. Okay, and there is no haircut, that should be applied on the level 1 to include in the HQLA. Okay, so what are the example for the HQLA level 1? So see the level 1 example. It include the cash. Obviously whatever the cash you have, you cannot apply the haircut on that, right? Next, and the cash which is in excess of a requirement of a CRR. Whatever the CRR, if you are having lended that a cash with RBI in excess of CRR, that will be counted in the level 1 because it is most secure, right? Next, government securities in excess of the SLR, that is also counted in the level 1 because that can be easily liquidify to have the cash. And next is the marketable security or the guaranteed by the foreign sovereign or foreign government, that also included in the level 1 because that are having highest security and that can be encashed definitely. So that are included in the level 1. Okay, now we will discuss level 2. Okay, what is level 2? So obviously it is somehow down level as compared to the level 1 assets. So what is the level 2 assets? See, the level 2 assets comprising of a level 2A assets and a level 2B assets, that we have discussed because level 2 is having two types, that is A and B. So we call it as level 2A and level 2B, right? So that include the in the stock of a liquid asset subject to the requirement. So what is the requirement? That should be included in the HQLA, provided that they comprise not more than 40% of overall stock of HQLA after the haircut have been applied. So what do you mean by that? See, suppose the total HQLA you are having suppose 100 CR. Okay, so whatever the level 2 asset, the limit for level 2A and B include, that is we can say level 2, the limit will be not more than 40%. So it should be not more than 40 CR. Okay, so limit is 40%, that means up to 40 CR. You if you are having level 2 assets of 60 CR, so you have to just count only 40 CR will be counted in case of a HQLA, because the limit that they have set for HQLA is 40% of the overall stock. So it is very, very important, friends. You have to remember for level 2 assets how much amount you can include that level 2 in the HQLA. The answer is 40%. 40% of HQLA can be counted as a level 2 assets. Okay, so further level 2 is divided into 2A and 2B. Okay, so what is the level 2A? Level 2A is a minimum 15% haircut should be applied to the current market value of each level 2 asset to held in the stock. Level 2A assets are limited to the following. So basically what we have learned, level 2 is having two types, level A and level B. Level 2 is the limit is 40% of HQLA, and for A they have stipulated that whatever the level 2A assets you are having, you should apply 50% haircut on that. That means if you are having 100 CR value of a level 2A assets, you should count only 85. You should count only 85 to add in the HQLA. Okay, so that is the all about the level 2A assets. Okay, now see what the actually level 2A includes then. So here is some example given. The example is not that much of important, but for better understanding and for if you want to study in detail, then only you can go for the example for the level 2A. Okay, so see, we'll discuss in a brief. It includes the level 2A. The level 2A include what? The marketable securities representing the claim on the or claim guaranteed by the sovereign. The claim guaranteed by the sovereign, public sector enterprises, entities or multilateral development banks that are assigned 20% risk weightage under the Basel II standardized approach for a credit risk, provided that they are not issued by the bank, financial institution or NBFC. Okay, so that are in the level 2A. So just if you have to remember, you just remember the weightage. It is a 20% weightage. Okay, that weightage you have to remember if you have to remember. Okay, next, because they can frame a MCQ based on that. That is not, I think it will be not provided in your book. Okay, that is very, very important. That's why it have some importance, right? So in that way they can frame a question. Now see, second, the corporate bond, which the bonds not issued by the same bank or the NBFC, which have been rated as a double A, are eligible and approved by the credit rating agency. So what is included in the 2A? Having rating double A and more, having rating double A and more of what, of a corporate bond are included in the level 2A assets. Okay, also the commercial paper which is not issued by the same bank, for example you are having commercial paper, you are working in SBI and you are counting the commercial paper issued by the SBI in the level 2A assets, then it is not allowed. You should have, if you are having in SBI, then you should use the, for other banks, for example UBI's commercial paper for counting in the level 2A assets. Okay, so remember the commercial paper also allowed in the level 2A, provided it should not be issued by the same bank and the rating should be 2A and above. Okay, very simple. For remember, it is very easy to remember. For a corporate bond and a commercial paper, rating should be more than 2A, or you can say double A. For what? For 2A category. Simple. In this way you can easily remember. Okay, now next we will discuss the 2B category. So what is the 2B assets? So I repeat here, we have discussed we are discussing HQLA. In that we are having level 1 and level 2. Level 2 we are having 2A and 2B. Okay, so that we are going to discuss level 2A, level 2B. A we have already discussed. Now we are discussing level 2, that is the level 2B. Okay, so see, in case of level 2B assets, the minimum 50% haircut should be applied. What we have discussed in case of 2A, level 2A, there is a 15% asset, 15% haircut. Okay, but in case of a level 2B, there is a 50% haircut. So such a high amount of haircut should be applied. Okay, and further, level 2B assets should not compromise of more than 50% of HQLA. So what we have discussed in case of in the beginning, we have discussed the amount of limitation that have prescribed on the individual type of the assets. So here you have to remember, in case of a 2B, that should in case of a 2B, the 15% of HQLA should be allowed. That means, see, if a total HQLA value is your 100 CR and you are having level 2B assets of a category, you are having suppose 60 CR, then whole 60 CR will not be counted in the HQLA. You can just have a 15 CR, that is 15% of HQLA will be allowed to count in case of a HQLA stock. Okay, so just remember that 2 point is very important that you have to remember. What is the haircut limit? Haircut is a 15% and amount that you can count in the HQLA is should be maximum is 15%. Okay, so that you have to remember in case of a 2B. Okay, so here is some again example given in case of a 2B. The marketable securities representing the claim or the claim guaranteed by the sovereign bank having a risk weightage 20% but 20% but not higher than 50%, that is they should have a credit rating not lower than BBB. Okay, as per the RBI circular on the Basel 3. Next, and the common equity share, if you have to include the common equity share in the category of a 2B, which will satisfy the following condition. First, it should not be issued by the same bank. It is common sense, you can apply. Next, B, it should be included in the NSE, CNX, Nifty index or the SP, S&P, BSE, Sensex. So it should be included in that. That means if you have to consider whatever the share holding, whatever the shares held by the bank, that is our asset, you have to classify, and definitely we have to classify in case of a 2B in the category of a level 2B. Okay, and provided that share should be listed in the BSE and or the NSE. Okay, and it should not be issued by the same bank. If you are having SBI, as you are working in SBI and you say I have a SBI share, we have issued just 500 CR shares, so that will not count it. It should be of other bank. It is very easy. So that are some basic example of a level 2B. Okay, so I repeat here the case study we have to discuss. Okay, so basically what is we have discussed till now? See, we have discussed the LCR, right? After that, what we have discussed, the LCR, we should have the formula is HQLA and divided by 30 days cash outflow. That is the formula for that. What is HQLA again? We have discussed HQLA is divided into level 1 and a level 2. Level 2 is further we have discussed divided into the level 2A and 2B. Okay, so that we have discussed. In case of A, there is a 15% haircut. In case of B, there is a 50% haircut. Okay, that we have discussed. Okay, so see, based on that we have to discuss the case study. So how the question can be asked in your examination. So see, find whether it is complying the LCR guideline with RBI or not. And second, they are saying compute the LCR, that is a liquidity coverage ratio we have to compute. So first, what they have given, see the name of the asset and amount in the crores. So level 1 asset they have given. What is level 1 asset? We have discussed, right? So they can easily sold, that is basically a level 1 assets. So what is the surplus of CRR linked with RBI comes under the category of level 1, that you all know. We have already discussed in case of your while discussing the examples. Now see, here we will discuss the case study. They have given level 1 assets. So 1, 2, 3, 3 level 1 assets they have given. First, surplus parked with RBI CRR is 1000 CR. Surplus in the SLR is 9000, and NDTL of the bank is 2 lakh. Okay, so these are the level 1 assets. Level 2 assets they have given the corporate bond with what is the category for limit, what is the mandatory guideline as per the RBI? It should be having a rating more than AA. So the corporate bond having a rating AAA is counted in the level 2A assets. So they have given 5000 worth. Commercial paper is of 3000 CR. Okay, they have given. And level 2B assets they have given here the corporate bond having a rating BB, commercial BBB, commercial paper rating BBB. They have given for a 3000 and a 2000 respectively. And they have also provided that the total cash flow in the next 30 days is 250,000, that is 2,50,000 they have provided. Okay, so next, what they have said, as per the RBI circular in April 2020, permitted level is a 90% of what? For what? LCR level is 90%. So whether we have to find, we have to check, we have to first compute the LCR, and whether we have to check whether is satisfy that level. Okay, that we have to analyze here. So how to solve? It is very easy and interesting. See, here is the solution provided. Okay, see, what is the level 1 asset they have given? Surplus in CRR they have given 1000. So we all know in case of a level 1 haircut is 0. In case of a level 1 haircut is 0. So definitely 1000 total will be counted in the LCR. Okay, so here I have taken 1000. SLR 9000, so total will be counted in the LCR, because in case of a level 1, remember there is no haircut. So but in case of a NDTL, they have given 2 lakh rupees of NDTL value. But in case of NDTL, to count NDTL in case in the HQLA or the LCR, we should take the only 2% of a NDTL. So 2% of a 2 lakh will be 4000. So 4000 we have to take in the eligible amount for the LCR. Okay, so this is all about the first, that is level 1 assets. So now what is about level 2? So see, for level 2 and level 2, in that we will discuss level 2A category. So for level 2A, what they have given? They have given the corporate bond. So the corporate bond value they have here, the corporate bond value they have given 5000. So we have discussed in case of a 2A, there is a 15% haircut. Okay, so in that case, so 5000 15% you have to subtract. Okay, so 85% amount is here, and for 3000 85% amount is here. Okay, so 85% we have to calculate. So 15% haircut is there. Remember what I say, the 15% is the haircut. So out of that you have to calculate the only 85% value should be considered. For what? For a 2A. Okay, so that I have taken here. 85% of 5000 is a 4250, and 85% of the 15% haircut we have to just deduct. Okay, now what is the same we have to do for a level 2B. They have given the corporate bond having 3000 and a commercial paper of 2000. But we all know in case of a 2B, what is a haircut? Haircut for 2B is 50%. Okay, 50%. So just to take 50% is to subtract. So 3000 50% will be 1500, and 2000 50% will be 1000. Okay, so here we have applied the total haircuts. So see again here, for a level 1 there is a 0% haircut. Okay, for level 1 there is a 0% haircut, so all value of level 1 you have to take as it is simply. For a level 2 there is a, what we have to apply, you have to apply the 15% haircut. Okay, that means 85% of value of a level 2A you have to calculate. So respective value I have calculated here. For a level 2B, what is the haircut amount? The haircut amount for level 2B is 50%. 50% only you have to consider. Okay, for level 2B we have considered the 50%. Okay, now next thing, we have to sum up the total eligible amount. We have to add using the calculator the total eligible amount. When you add, you will get the 23,300 will be your total value. Okay, will be your total value. Here remember, the corporate bond of 5,000 and a commercial paper is 3,000. Okay, so here when you add, you will get a total eligible for amount for LCR, there will be 23,300. What we call it as a HQLA. Okay, it will be 23,300. So next is a very simple step. We know the formula of LCR. It is a high quality liquid assets divided by cash outflow in the next 30 days. So HQLA here we have calculated. It is 23,300 divided by 2,50,000, which is provided in the question itself. They have stated the net outflow in the next 30 days. They have given 2,50,000. So when you solve, you will get a 93.70%. And they have stated in the problem statement that as per the RBI April 2020, it should be more than 90%. So we came up here with the calculation 97.3. So it is more than 90%. So we can say it follows the RBI guideline. Okay, so definitely the LCR whatever we have calculated, overall it follows the RBI guideline. Now we have to check whether the level 2B is satisfying the RBI norms or not. So what is the criteria for that? You should remember here. See, in case of level 2B, that should not be, total level 2B should not be more than 15% of total HQLA. Okay, that we have already discussed in our theory in just before few minutes, right? That should not be more than 15% of total HQLA. So what is level 2B assets? See, here is the level 2B value. Here is a 1,500 plus 1,000, you will get 2,500. Okay, so here you will get 25. They are asking about the level 2B. Okay, so value is 2,500. Okay, so just see, for 15% of a total HQLA we have calculated 2,300. See here, right? So 15% of a 2,300, you will get a 3,495, right? And what is the total 2B? Total 2B here is a 1,500 plus 1,000, you will get 2,500. So it is less than that amount. That means it is within 15% of HQLA. So we can say that 2,500 is less than 3,495. So it follows the RBI norms about the level 2B also. Now there is also one stipulation that for total level 2 asset, it should not be more than the 40% of HQLA. Okay, that also we have to check. So say, what is the 40% of a total HQLA? Just calculate 14% of whatever the assets you are having, right? So when you calculate, you will get 9320. And total 2B assets, what is the total 2B assets? So see here, total 2B, how to calculate? 2A is this and 2B is this. So when you add up, you will get total 2B, total level 2 you will get. By adding A and B, you will get total of level 2. Okay, it is very easy. Now when you add that, you will get level 2, and level 2 you will get 9300, and it should be not more than 40% of HQLA. So calculate 40% of HQLA, it is 9320, and the total 2B is 9300. So definitely it is less than that. So we can say it also follow the RBI norms as per the stipulation. Okay, so it is very, very important. That case study is very, very important, friends. I repeat, don't neglect that case study. It is the most easy case study. Okay, so I repeat here again, whatever the level 1 assets, you have to count that level 1 as it is, but in case of a NDTL, only 2% you have to count in the LCR. Next, for level 2A assets, there is a 50%, there is a 15% haircut. So out of that, only 85% you have to take. For a level 2B assets, there is a 50% haircut. So only 50% value you have to take and add all that. You will get a HQLA. Divide that HQLA by the amount for the next outflow in 30 days. That is a 250 they have given, 250,000. So you will get the LCR. Okay, and what is the overall stipulation as per the RBI norms? The level 2A should not be more than 15%, and level 2A and 2A plus 2B should be not be more than the 40% of what, of total HQLA you are having. Okay, so that we have already discussed. So see, I have done some mistake here. The limit for level 2B is 15% of HQLA should be less than 15%, and level 1 plus level 2 should be 40%. Minimum maximum limit is 40%. Okay, as I have already explained in the here, as I have already explained, for level 2B it is a 15%, for a level 2 it is a 40%. Okay, that you have to remember. So don't neglect this case study. This case study is very important. Okay, now next ratio we have to discuss is the net stable funding ratio, that is the NSFR. So what is NSFR? Net stable funding ratio. What do you mean by that? Funding, net stable funding, net, stable and funding. So you should have stable funding sources. You should have stable funding sources. That means whatever the money bank is getting should be stable. It should get stable. It should have source. That source of money should be stable. Okay. So basically, on the 17th May 2018, RBI came out with the final guideline on the net stable funding ratio to ensure bank have sufficient stable sources of funding to finance their activity over the long term. So we have discussed about liquidity coverage ratio. It is for the short term, say for 30 days we are just doing, but in case of net stable funding ratio, there is applicable for medium as well as the long term. Okay, now we will discuss. See here, the liquidity risk up to 30 days is taken care by the LCR, but the liquidity risk beyond 30 days and up to including 1 year is taken care by the NSFR. So here is again MCQ, that liquidity risk that is stipulated, that is insured by the LCR is for only for the 30 days, but the liquidity risk insured by the net stable funding ratio is up to 1 year. Okay, there is also very important you have to note. Okay, so what we have to discuss, see here some theory part about the NSFR. The NSFR limit over reliance on the short-term wholesale funding encourages better assessment of funding risk across on and off balance sheet items, promotes the funding stability. The ratio is defined as the amount of available stable funding in the relation to the amount of required stable funding. So what is the formula for see, it is very easy. You just remember the formula for the standard net stable funding ratio, that is NSFR. The formula for NSFR is simply the available stable funding divided by the required stable funding multiplied by 100. Okay, so it is very easy, and provided RBI says it should be more than your 100%. Nothing to explain in that. It is the most easy type. It is very easy and less complicated than the LCR. Very simple. Whatever the available you are having, just divide it by the required, you will get the NSFR. Whatever the available fund, divided by required fund. Simply. Okay, you will get the NSFR. Okay, and RBI mandated that it should be 100%. It should be minimum 100%. Okay, and RBI has prescribed 5 category. RBI has prescribed 5 category of stable funding sources. Okay, and that is called as the ASF. That is the available stable fund factor. That is called as the ASF. That is available stable fund factor. Okay, so remember RBI has prescribed 5 category of stable fund. and that is called as the available stable fund factor, ASF. Okay, so if you are getting some word about ASF factor, so don't get confused, it is just a category of stable funding sources. Okay, so next what we have to deal with that, according to the RBI there is some guidelines. Okay, that is not that much of important. Okay, but we will discuss it. Okay, as it is in the syllabus, we just discuss it in the broader view. See, accordingly the total regulatory capital excluding the tier 2 instruments with less than 1 year maturity have a 100% weightage. For what? For the net stable funding ratio. Okay, next, the term, whatever the term deposit having maturity less than 1 year, and a demand deposit, that is saving and current balance, or through the retail customer, have a ASF factor 95% weightage is there. That is ASF, that is available stability fund factor is 95% you can take. And funding with the residual maturity less than 1 year provided by the non-financial corporate customer, sovereign, multilateral, or the National Development Bank or Central Bank or any financial institution should have the factor of 50%. So basically, the term deposit having less than maturity of 1 year and demand deposit have a factor of 9. What is the factor? That is available stable fund factor is 95% for that. And the same if you are canvassing from the banks or financial institution, have the factor, that is available standing factor. Here we take in the LCR we call it as a haircut. Here just we call it as a available stable fund factor. Okay, it is 95%. And for a bank, if you are taking some FD or deposits from other bank or financial institution, it is a 50%. Okay, that is counted in the net stable fund. Okay, now see, here is the next guideline. As per the RBI circular on September 2020, it stated that due to the uncertainty due to the COVID-19, it is decided that defer the implementation of NSFR by further 6 months, and these guidelines are effective from 1st April 2021. Okay, so there is also important point, that is the latest development about the NSFR, because they can ask one liner question that when the RBI has further decided that defer the implementation of NSFR. Okay, so in the September when RBI come with some ex gratia scheme, that time the RBI has given that guideline also. Okay, so next there is also one facility that we will discuss here. So basically that facility is called as the FAL LCR. So see, that facility, that is called as the facility to avail the liquidity for liquidity coverage ratio. The facility to avail the liquidity for liquidity coverage ratio. That means to maintain the LCR, there is also one facility provided by the RBI. Okay, the RBI says that bank should maintain the LCR. But how can bank maintain? If bank is having some difficulty, then bank can use the facility, or we can say the scheme provided by the RBI, and the scheme is called as the facility to avail the liquidity for liquidity coverage ratio, simply. Okay, so it is also effective from the 1st January 2015, since the LCR was applicable. Okay, so what is the eligibility for that? Eligibility is the bank which is under stress is only eligible to avail the facility for the liquidity coverage ratio. See, the bank which is in good condition can easily maintain the liquidity coverage ratio. Okay, but definitely the bank which is not able to maintain that LCR, we can say that bank is in the stress condition, and that only the banks are eligible to avail that facility. Or it is very simple, right? And also the banks which are having, if the bank is in good condition, bank will have good HQLA, that is high quality liquid asset, definitely. So bank can easily maintain the liquidity coverage ratio. If the bank has exhausted that high quality liquidity asset, that we can say if the HQLA is exhausted by the bank will face to stress scenario, stress situation, stress crunch to be faced by the bank. That's why there is also another condition, it is common sense conditions. If the bank is under stress, bank can use that facility. If bank has exhausted all the HQLA, there is also that eligibility condition they have put. Now the important thing, what is the maximum tenure the tenure, the period of that, basically it is basically simply a loan, right? So it is basically it is a loan facility. It is a loan facility for what? To maintain the liquidity coverage ratio, in simple words. So the tenure of that facility is 90 days. What is the haircut? It is stipulated as stipulated for the MSF, that is a marginal standing fund facility. Okay, and the rate of interest, that is very easy. The rate of interest should be 2% more than your repo rate. The rate of interest you are availing under the the facility availing for the liquidity coverage ratio will be rate of interest will be 2% more than the repo rate. That is what is it, 200 basis point above, that means it is a 2% more than your repo. Okay, it is very easy. So that part we have discussed here. So here is also, remember, the liquidity risk monitoring tools. There are total 5 liquidity monitoring tools. You just go through that. First is the contractual maturity mismatch. What is a contractual maturity mismatch? If there is mismatch in the assets are for 5 years and a liability is only for 3 years, there is mismatch, right? So contractual mismatch. Concentration of funding, whatever the source of fund you are having is they are concentrated from only one source, then we are having concentration of funding. Next, available unencumbered assets, that is also the monitoring tool, that it should be high. Okay, whatever the unencumbered assets you are having, it should be high. It should be high, then it is good. Next, the LCR by significant currency. So we know the banks are also dealing in the forex. Okay, so if you are dealing with the forex, you should have the reserve of a forex currency. So it should be applicable. LCR by the significant currency, it should be there. Next, the market related monitoring tools are also there. Okay, so these are 5 basic monitoring tools. Okay, so based on that, actually what happened, see what is the actual case. See, based on that 5 tools, bank need to submit some report, statement or return to whom? To the RBI. Okay, so based on that 5 report, RBI will come to know whether bank is facing any stress or not. Do you getting my point? That means bank had to submit that much of a return with the RBI. From that, RBI come to know whether bank is facing that stressed condition or not. Okay, next, so what are that we will discuss here, right? So here the important next point you can remember that the submission of a Basel 3 liquidity return. Okay, there is chances that IIBF can frame a question based on that. So here we will discuss that. Okay, so first, statement on LCR. The periodicity for that is monthly. You have to submit that statement on the liquidity coverage ratio, and when you should submit within 30 days. For example, for the month of January 1st to 30, you should submit up to the 15th of Feb. Okay, so statement of LCR is monthly, and within 15 days itself you have to submit. Next, statement of funding concentration, it should be submitted monthly, and it should be within 15 days. Next, the statement about the unencumbered asset, it is quarterly basis. And you can take 1 month to submit that. Okay, so remember. Next, LCR by the significant currency, it is also monthly, and you can also take 1 month to submit that. And next is the statement on other information on liquidity, so it is also monthly, and you can submit within the 15 days. Okay, so that 5 basically these are the monitoring tools. So whatever we have discussed in the just previously, these are the monitoring tools. Okay, so remember, sometimes it is called as the Basel liquidity risk. So BLR1 we can call, here we can call BLR2, right? So we can call it as 3, 4 and 5. Okay, in this way you can call, because it is a Basel 3 liquidity risk, 1, 2, 3. In the RBI, if you are asking what is the, give me the statement of LCR, they will not entertain you, right? So here in the RBI they deal with the submit the BLR1, submit the BLR3, submit BLR4. In this way they are dealing. Okay, so here see what you have to remember and how you have to remember. Just remember, the periodicity of the statement on liquidity is generally monthly. See, you can observe except for what? Unencumbered asset, it is just a quarterly. So here you get more time, it is more frequent, it is more they have provided more time to submit the quarterly, as it is having it is monthly, it is quarterly, so it is more it is you have to submit less. In 1 year you have to just submit 4 quarters are there, so definitely it is quarter is more than a month. So in case of a monthly, just submit it within a 15 days. If a periodicity is monthly, it is a 15 days, you can observe. But in case of the if it is quarterly, and which is quarterly, the unencumbered, it is a quarterly, so that's why it is a, here you can easily remember it is a monthly simply. And obviously whatever the significant currency, that is mainly the forex currency, it is a monthly statement should be provided. And there is also, you can submit February, you can for February you can submit up to the March 31st. Why? Because here there are forward contracts are involved, forward contracts are there, some cancellation of forward contracts, so there is some calculation are involved. So for that there is a the delay that time provided by the RBI, you can submit up to within a month. Okay, so in this way you can remember. Okay, if you have some that you can remember. So I repeat, just remember, periodicity is generally monthly except for the unencumbered asset, it is quarterly. And when you submit, you should submit within 15 days. But as it is for the quarterly for unencumbered, we can submit it for the within a month also. And obviously for the significant currency, we are dealing with the forward contracts and cancellation of contract, etc. is involved, so we can take 1 month for submission. In this way you can remember. Okay, this is a very easy trick I have told you. Now see, we have come up with the end of this chapter. So do one thing, do subscribe our YouTube channel. Bankers Zone is the name of YouTube channel. If you are preparing for the CAIIB, you have to join the group for a CAIIB. The name of a group which is available on the Telegram application, and the name of the group is CAIIB space banker space zone. Okay, this is the name of the group. You can directly search on the Telegram, or you can directly search on the Telegram @CAIIBBZ without space. You have to join our group for CAIIB preparation. Next is that you have to download the application from Play Store, Banker Zone CAIIB. So friends, happy learning. And friends, do one thing which is very, very important. You should share this app link with your colleague in the bank. Okay, so friends, all the best, happy learning.